Hi, and welcome to this month's Trade Floor Update. Today I'm joined by Portfolio Manager Aditya Thakur. Aditya, what did we see happen in markets and rates last month?
Yeah, a very busy month in May. We had a fairly risk-off tone in global markets. So the S&P 500 was down about 6.5%, and that really led a strong flight to quality response into bonds, which rallied very strongly. US 10-year rates were down around 35 basis points, and Aussie 10-year rates rallied around 31 basis points. And so the reason for these market moves was twofold. Firstly, there was an increase in geopolitical risks, with US-China trade negotiations continuing to deteriorate. At the end of the month, we also saw a surprise announcement by the Trump administration to threaten tariffs on Mexico in order to address immigration issues. And thirdly, I'd say that the global data continued to disappoint this month.
Now, after seeing the RBA cut rates to an all-time low of 1.25%, will we continue to see bond allocations out-yielding bank term deposits?
Yeah, really good question. With the RBA cutting rates to 1.25%, and as Dr. Lowe said last night in his speech, more than likely to go to 1% shortly thereafter, savers are going to be penalised because term deposit rates, all deposit rates are going to be sub 2%. Now with inflation running just a little bit below 2%, that means that deposit rates will offer zero, if not negative real returns, i.e. your purchasing power after inflation will be diminished. So even though absolute yields on bond funds are historically low, they're still offering positive real returns. And the second point I'd mention is that this point in the business cycle, as we're entering the very latter stages of the cycle, and as recession risks are now clearly on the rise, bonds can continue to outperform. So we think that they should really be a central pillar for client portfolios in terms of diversifying and defensive characteristics for their overall portfolios.
Has the coalition victory at the recent federal government election changed your outlook for Australian growth? And if so, how?
Yeah, the market certainly took it as a mild positive. So I think there are three positive points from the election. Firstly, the prospect of near-term tax cuts will provide a little bit of a boost to household income, discretionary income. Secondly, with negative gearing now to remain in place, it removes somewhat of a left tail risk for the housing market. We've also seen some relaxation of lending standards by the regulator. And thirdly, typically after an election, you do see a little bit of a boost to business and consumer sentiment, just given that the policy outlook is now a little bit more certain. So when you wrap all those three things up, it was certainly taken positively by markets.
Well, thank you very much for joining us, Aditya. As always, we really appreciate your insights.
Thanks very much.